I was reading a statistic about how the US markets have done or outperformed world markets in 14 out of the last 15 years, right? And 2 years on a trot now have been superb returns. What's the JP Morgan view about, let's say, US markets in 2025? And could what the mother market do, will that have a large implication on what emerging markets like India do? Or will we have a different course, never mind what the US markets does?
The longer term correlation of relative performance of, let's say, equities or currencies is driven by relative growth outlooks, right? In the short term, you talk about interest differentials and inflation differentials and all that, but the medium term correlation is very simple: asset prices driven by relative growth. And if you look at, let's say, the US economy, and this is now popular in the press, many people are talking about how the EU was as big as the US, in 2010, 2012 or something around that, and now the US is 50%, 60% bigger than the EU. The relative growth dynamic has been favorable to the US for a very long period of time. Yes, EM has had better growth, but EM has had currency issues as well, right? So there has been particular volatility in other risk-adjusted parameters for EM. But if you take global GDP, the US has actually done much better in growth than many other parts of the world. And this has driven the outperformance of its market. You can bottom up also point out to many technological changes that have happened, the whole boom in the, let's say, the internet companies to begin with, now AI driving tech stocks in the US. But ultimately, it's a relative growth argument. And if you use that framework, Niraj, then for next year, are we arguing that either Asian growth or European growth is going to accelerate more than the US? The answer is probably no, right? For EM, China still dominates in terms of the GDP contribution, etc. And there is potential for China to do well if the stimulus comes through, but there's a lot of ifs and buts around that. So let's assume that the Chinese government did decide to stimulate in size sometime next year, post CNY, let's say, then we can review our opinion of EM growth. But absent any of that, it still looks like the US will grow faster, risk-adjusted for than most other economies.
So I'm glad I don't have your job, because I'm about to make your role a bit difficult. But here's my question to you. Let's assume, hypothesis, China does stimulate. The recent noises do seem that they want to, right? Let's assume they do stimulate. Let's assume the US tariffs are not anti-growth and are not very inflationary as well, right? So therefore, you have a US market which is doing well, or the US economy and markets doing well. China stimulating, maybe China also doing well. India coming out of a growth patch and unpredictable growth, or growth lull patch, and therefore unpredictable, but maybe better than what's happened in the last 3. Where does money find its way?
Okay, assume that China stimulates. Now, there can be stimuluses of various forms and colors,
the
right?
Best case scenario.
Let's say they do a broad-based consumer stimulus and they hand out money, which is not anybody's base case. Its idea is more of an infrastructure, real estate stimulus. In any case, people will start off with the assumption that the impact of the stimulus is likely to be temporary because of the underlying demographic headwinds that the Chinese economy faces. So you may get a spurt of interest in China or in EM assets because the flow through of Chinese growth into EM can be reasonable. You may get that period where you get interest in China, but everybody is very likely to approach it more as a temporary phenomena rather than a permanent change in the direction of growth, really. In this, India has stood out historically. So if you look at the performance of, let's say, MSCI India to EM, India's behaved like the S&P 500 up until the elections in the US were conducted, right? Because Indian growth was different from EM growth for a very long period of time. Okay, but as the administration changed, we got the results, let's say, of the US elections, India is now bucketed in with EM again, and India's performance is now tracking EM assets more than the S&P because of the shift in perception, Niraj, that the policies of the new administration is US first. Right. And everybody else, doesn't matter, friend, foe, whatever, US first, US exceptionalism, my growth comes at your cost, right? So India is now being lumped back with EM in investors' minds for now, right? But can India outgrow EM? Well, that's our hope and base case, to be honest, and it should be outgrowing the rest of the EM next year as well.
Okay, and one small macro before I get to the minutiae, if you will, but from a slightly 50,000 feet view, is this: if the U.S. were to slap tariffs, left, right, center, let's say Donald Trump does that, and if that is inflationary, let's say, and therefore this belief that U.S. might also continue on a rate cut trajectory doesn't quite turn out to be true, and the U.S. were to hike rates as opposed to cut rates, what happens to policies back home, for example? Because a lot of people argue that we need the rates to come down in order to stimulate capex growth, so on and so forth. Will the RBI still be able to do that, or could there be a spanner in the wheel?
This will cause trouble. Now, there are multiple variables through which that tariff will impact policy making, right? First, how do you counteract tariffs? Suppose they impose tariffs on China or Mexico or any of the countries that he's talking about. One way that economy can react to tariffs is by allowing the currency to depreciate, right? And that's what happened the last time around as well. So let's assume in response to tariffs, the RMB were to weaken. Indian policymakers cannot allow the rupee to strengthen relative to the Chinese currency, because that will then force more Chinese imports into India. So you may not have any tariffs imposed on you, but you will also have this incentive to have your currency depreciate in line with every other major economy. You don't want to lose your export competitiveness, right? So there is a currency risk even if there are no tariffs imposed on us directly, okay? The inflation will be ring-fenced in the US, right? If you put tariffs on the rest of the world faces deflation. Right? Because my growth slows down, my ability to export to you reduces, and therefore I have more surplus production, which I have to sell to fewer amount of people. So I actually face deflation, and the US economy probably faces inflation. So slower growth for everybody else, inflation in the US growth, we will think about how that plays out. But for policymakers in EM, you are faced with the prospects of potential currency depreciation and slower growth and deflation. So ideally, you want to cut rates in India as elsewhere. This will depend on how bad the currency depreciation is. Because if currency depreciation is very harsh and you see dollar outflows of any economy, not just India, let's say, you then don't want to cut rates. So, put this in a nutshell, right? The policy choice that faces many central bankers over the course of 12, 18 months, do you cut rates to drive growth? Do you keep rates high to save the currency? My sense, most will choose to cut rates to drive growth, because the saving the currency is probably going to be futile.